Before we begin, a disclaimer: this podcast is for informational and entertainment purposes only and should not be relied upon as the basis for any investment decision. Nothing you hear is an offer or solicitation to buy or sell any security. The securities discussed on this podcast may be owned by persons being interviewed. Before making any investment decision, please consult an investment advisor.
Okay. So post-Thanksgiving podcast, huh?
Yes.
Okay, so we still have Thanksgiving hangover, but we're gonna touch like a couple of interesting talking points, or topics. So first, we're gonna talk about serial acquirers and ROIC. Obviously, a lot of serial acquirers are uncharacteristically going through a lot of pains recently, right? Like I was actually wondering, like if obviously companies like Constellation Software or Judge Scientific, or like Vitec and or like there are like other successful compounder bro favorite serial acquirer stocks out there who are all kind of going through a pretty material drawdown at the same time. And I was actually wondering if someone, fell in love with this serial acquirer, kind of theme and probably own a bunch of these stocks, they're going through a pretty rough time. And I think for the first time, if I'm not mistaken, Constellation Software is actually experiencing a 40% drawdown. So it's definitely the first thing. And obviously Constellation being the most successful compounder in this particular genre, it definitely attracts a lot of attention. So I've been thinking a lot. I used to own Constellation Software, and I actually started buying during this drawdown period. And so I've been thinking about Constellation a lot. And I wrote a piece, kind of, when I started buying the stock, I wrote a piece, and I mentioned that Constellation has 30% ROIC, right? And a couple of people actually pushed back and said, hey, I think you are being too generous in calculating your ROIC. And I kind of thought through it, and I thought their argument was pretty cogent. And I kind of thought, okay, it makes sense, the pushback that I received. And I ended up calling you, right? And we kind of had a discussion, and I kind of realized that yes, those pushbacks are pretty valid. So I just want to clarify what exactly those pushbacks are and what mistakes that I think I made initially, right? So for a serial acquirers, the name kind of says itself. They're constantly acquiring things, right? Every year they're serially acquiring things, right? Companies. The Constellation is no different. They're buying tens of software companies every single year, and as they buy new companies, they so they usually have like a pretty sizable intangibles component to their acquisition price, right? So whatever the book value these companies have, let's say if they bought something like $200 million and $100 million is the book value, then the rest of the $100 million actually is regarded as intangibles, which gets amortized over a specific time period going forward. And so what I used to do is basically I would take the NOPAT in the numerator, right? And the way I calculated NOPAT is basically earnings before interest, taxes, and amortization, to kind of negate the volatility associated with amortizations and different cycles in terms of when they're acquiring more, when they're acquiring less. So kind of to negate that sort of volatility, EBITDA is probably better to gauge the underlying health of the business. And in the denominator, I used to have just the invested capital, which I calculated as total fixed asset and total working capital. The challenge with that approach is, and the pushback that I received, that when I'm calculating, let's say, the total fixed capital, I am taking, I'm not considering the accumulated amortization of all these acquisitions, and it's very intuitive, and that's why it's pretty clear to me the moment I received pushback that hey, I'm probably off here. The reason is it's a pretty simple explanation. Like, for example, if you bought $100 million of intangibles, and let's say you are amortizing it over 5 years, right? So 20 million each. Let's just assume that. So then in year one, let's say it makes like $15 million, right? So you're getting on the $100 million intangibles or the acquisitions, you're getting like 15% ROIC because you are making $15 EBITDA, right? But as the time progress, uh, because of amortization, your invested capital base automatically shrinks every single year. If you are using like a 5-year amortization, then this $100 invested capital becomes $80 after year one, then $60 after year two, and eventually it becomes zero, right?
Mhm.
And then whatever book value that you paid, let's say if you paid $100, or so let's say $50, then even if your earnings do not increase over time, let's say it's $15 million every single year, so your earnings has zero growth, it's not increasing at all, but your ROIC will just automatically, like methodically increase every single year just because your denominator is diminishing,
Mhm.
right? So if you do that for any serial acquirer, you are just systematically inflate the ROIC because they are amortizing it over time. And remember, your numerator is EBITDA, right? So you're adding back amortization, right? ROIC. So I kind of understood that, and I kind of redid the whole exercise. So what I initially thought CSU's Constellation's ROIC to be 30%, once I do that adjustment, it gets closer to like sort of like high teens, like
Yeah,
17%.
I think the key is you want to be consistent with your numerator and your denominator. So if you're adding back
Exactly.
amortization in your numerator, you got to add back accumulated amortization denominator. If you're adding back depreciation in your numerator, you've got to add back accumulated depreciation denominator. And I called this out in the biotechny piece from earlier this
Yeah.
year because their management team, I noticed that
You
when
know
they
what, David?
calculate,
When I received that pushback, that's the first thing actually that came to my mind. I'm like, hey, I think Scuttleblurb also mentioned something like, and that's why I actually called you. Like, and he would know because I think he explored this sort of like topic when he was writing about biotechny, and I think you mentioned the point that biotechny management talks about how they are generating pretty attractive ROIC, but when you calculated it, is like,
that's right. Yeah, because they add back amortization expense in the numerator, but they
I
use
see.
book capital in the
Oh,
denominator, right? So
nice.
they don't add back the accumulated amortization, right? And so,
Right.
but when you made the proper adjustments, the ROICs obviously looked far less flattering. And
Yeah.
I will say I thought it was also funny, like in their proxy, they had noted that there was a shareholder request for them to include ROIC as in their incentive compensation, and management resisted. And the explanation they gave here, and I quote, an ROIC measure would risk disincentivizing strategically beneficial investments and undermine long-term shareholder value, which I thought was great.
Oh, that's funny. That's funny.
Yeah,
I don't think I've ever seen such
I've never seen that.
explanation.
Yes.
That ROIC will undermine. Okay. Okay.
Yeah.
Interesting. Yeah.
And I will say a few other things on
Mm.
this. I think some of you listening may have read my Atlas Engineered Products post from last year,
Mm.
and the ROICs calculated from their financials was nowhere near what would be implied by like the single digit multiples they said they were paying, right? So
Mm.
like you want to, so with these serial acquirers, you want to like always check that the calculated ROICs make sense in light of what they say they're paying for deals. So,
Right.
if a serial acquirer is saying they're paying 3 times EBITDA for roll-ups, but then the calculated ROICs are like 9%,
Mm.
that should be like kind of a flag
Yeah,
here
that's a
that
red
that's
flag.
something you
Yeah.
should be
Yeah.
concerned about, look into at the very least. And the other thing is like, don't forget about impairments in your denominator, right? So,
Yeah.
your ROIC calculation this year might be 15%, but maybe the company impaired its intangibles and goodwills like 5 years ago, right? So you need to
Mm.
include that in the denominator, because the thing about goodwill and intangible impairments is that while you have to write them down if conditions turn against you, you're not allowed to write them back up when
Right.
the environment
Right.
turns. So like
we're
David,
we're,
you're teaching CFOs how to game these numbers. Don't do that.
yeah, and where I
The-
noticed this was like Charles River. Charles River, it's a serial acquirer, and
yeah.
like back in 2004, they made this huge acquisition of a competitor called Inversec, and they paid like over a billion, 1.4 billion in cash and stock. It's like 23 times EBITDA, some huge multiple. And they had to take a huge impairment on that. And so, when I looked at Charles River and I made the adjustment and I added back that impairment, I mean, it looked like maybe they were earning, 10% pre-tax over a very long period of time, like 20 years, right? And so, so that's just like another thing to, keep in mind. And sometimes it makes sense to not add back the impairments. Like maybe there's a new management team, a total
Yeah.
change in strategy. And so adding that back would give you some distorted view. So you got to consider this stuff
Yeah,
on
I
a
mean,
case by case
if the
basis.
management itself is making a big claim of their great capital allocation history, but it kind of is saddled with a lot of these impairments and or the lost amortizations over time, then you should not be overly generous. But yeah, as
Yeah.
you point out, if it's a new management and you probably don't want to penalize a company too much for their past mistakes from earlier managements, right? So that's. I think the other point you mentioned a few moments ago was the pushback that I received after I kind of adjusted the ROIC calculation. Like someone said, "Hey, if you are adding back accumulated amortization in the denominator, why don't you do that for Amazon, right?" And again, to your point, it's very important to make sure the numerator and denominator actually match, right? Like you are thinking about this in a logical manner, right?
Yeah.
So yes, if you are putting EBITDA for calculating ROIC of Amazon in the numerator, then you should add back those depreciation and amortization, right? But when I calculate Amazon's ROIC, I just put operating income, right? EBIT,
Yep.
right? And I mean after tax operating income, and in the denominator I don't add back amortization because I don't need to, right?
Yeah.
So
right.
it's just just think it through. Like don't try to memorize or anything. Like I should do this and that. Like just think it through what you are doing, why you are doing. Right. Again, the reason I'm using EBITDA in the numerator for serial acquirers because they just chronically acquire companies. Right. That is kind of a very core part of their business, core part of their capital allocation. Right.
Yeah.
So and to gauge the underlying health of the business. It is useful to add back amortization, right?
Yes.
That's why I'm doing that. That's not the case for Amazon, right? That's not the case for, let's say, most companies, not just Amazon. Just think it through. And it's really simple. And like I said, it's not like I was fighting with myself that whether I was right or wrong. Like the moment someone kind of explained it to me, it was pretty obvious to me. Like, okay, I need to take into amortization into this equation. But yeah, a lot of people don't do that, and I think it can lead you to. And personally, for me, I think the reason this exercise was value add for me is if I assumed a business is 30% ROIC when it's actually, let's say, 15 to 18% ROIC, I'd be much more aggressive, in buying the stock, right? Like, the stock is down this much, and this company is going to allocate capital at 30% ROIC. The kind of valuation range that you'll come up with, if you assume that, can be very different, right? Will be substantially different if there's like a 10, 12 percentage point difference. And again, and I kind of do the exercise for other serial acquirer companies as well. So, for example, Danaher, I found out that they're making barely high single digit, if even that. So I think Danaher is making 7% ROIC when you add back all the accumulated amortization. Even if you think, okay, they are still kind of there's this long hangover post-COVID period, right? And obviously they also unfortunately used a lot of capital to buy inflated deals, right? During 2021, 2022, Aldebaran comes to my mind, when you think about that. So even if you ignore like recent years ROIC, I was actually surprised that when you calculate Danaher's ROIC in that manner, it was actually consistently around like 7, 8, 10%. It was like in the last 10 years or so, it was never like 15% or like 17%, right? It was actually consistently, I think highest was like 10, 11% during the COVID boom, when they were like this wild beneficiary of COVID era spending. And then right after COVID like boom ended, they came back to like 6, 7%, which used to be the case actually before COVID. So that was sort of
Yeah.
like eye-opening exercise for me. And then that obviously informs me what sort of multiple I'm willing to pay. How did the management allocate capital in the past? And frankly speaking, it made me think it's not an easy decision. It's not like, I kind of go back and forth on this. At one hand,
Yeah.
I think Danaher management should have probably just given special dividend during those like pandemic era boost. Like obviously they could either do that, or they could just use the capital to buy like other companies. But those other companies are also pretty
Yeah.
inflated at that time, right?
Yeah.
But
I mean, if you were to go back to like 2000, if you were rewind the clock maybe 12 years or something, and go back to 2000, 10s through 2000, before 2015 essentially, and they're buying these, stuff like Beckman Coulter and Leica and these kind of companies at like single digit EBITDA multiples, and then they improve the performance on that. Yeah, they're earning some pretty good ROICs on those deals. But then what about Aldevron, 40 times EBITDA? What about Apcan, like 35 times EBITDA, even like performing the margins, right?
Yes.
Or
different times, David. Different times.
They're putting big money to work. These are not $100 million deals. Aldevron, 10 billion. Abcam, 6 billion, right? These are big
numbers.
Big numbers at big multiples. So that's going to really going to dilute your ROICs, right? Yeah, all this stuff kind of post-COVID or during COVID, post-COVID. That's a bit more suspect, I think.
But what do you do, David? For example, like when I imagine myself in Danaher management's shoes, so let's say you have like, I don't know, let's say $10 billion cash, right? So you're thinking through, what do I do with this $10 billion cash? So do I pay special dividend? That's one option. One other option could be, acquiring something. The problem is, obviously, you are not operating in a vacuum, right? You look around and see, oh, what is Thermo Fisher doing? What is Sartorius doing?
Exactly. Yeah.
Right? And they're buying like bunch of, so if you don't participate in that, then maybe what you offer to the customer, so you don't have the end-to-end sort of offerings, right? So then you feel like, I probably am forced to kind of participate in this.
Yes, exactly.
Even if I think the ROIC will be lower.
Yeah, and I'll have a follow-up post on both Thermo and Danaher probably next month or the month after. But I mean, it's not just that they're paying bigger multiples and putting a lot of dollars to work at these higher valuations. It's also, I felt like the nature of the nature of these acquisitions was different than what they were in the past. It's not like, it's not buying this beat down business at single digit multiple and improving the operations and realizing a big return. These felt more like R&D type bets, right? Or if not R&D bets, bets on just the next big therapeutic modality, and that just seems different. It just seems qualitatively different. So it's not like with Constellation, for example, like they may be putting a lot of dollars to work, and but the playbook is very clear, right? They know how they've been doing this, and they're not making R&D bets. They're just kind of buying the same stuff they were buying. Qualitatively speaking, they're buying the same stuff they were buying 10 years ago, and it's a lot easier to kind of gain confidence in that than Danaher or Thermo or whoever placing a big bet on like cell and gene therapy, because that was kind of like the hot thing post COVID. It's a bit different,
Who knows? Maybe CSU is making R&D bet thanks to AI. They'll be left behind. That's the bet. They'll be left behind.
Yeah. But you're right though. It's a hard problem because everyone during the boom. I mean, there was no one in the bioprocessing life
Yeah,
sciences space that I think was immune to this. Everyone was
exactly.
paying these huge multiples for it. And if Danaher didn't pick them up, then Thermo would have picked them up, or Sartorius would have picked it up.
You know who I
And
blame all this for? I blame the investors, people like us. Like
yeah, yeah.
it's not their job to they obviously don't price the stocks. We do, right? And maybe
Hmm.
we should have been more skeptical. Like, hey, they're buying stuff at like 40 times, 35 times EBITDA when they used to pay like 8 to 10 times. Maybe we need to we probably need to reassess the multiple for these businesses, because if they are obviously allocating capital at 35, 40 times EBITDA, that's going to exert a lot of pressure on their ROIC and consequently multiples, right? So
Yep.
maybe it's investors' fault, like but I when I imagine myself in Danaher's management shoes, uh, it's not the easiest position. If your
Yeah.
competitors are also engaging in this sort of like trophy hunting acquisition exercise, obviously you don't know how long that will last, right? If you don't engage in that for like maybe a year or two post that hangover, possibly your competitors have just much better offering than you do, and that can have
Yeah.
a sustained impact on your core business. So I can see why they did that. Obviously, that didn't turn out to be great. And I guess in some level you could
Yeah.
say the current like sort of big tech debate has some similarity, right?
Hmm.
They
Hmm.
all have to engage, they all have to participate in this AI sort of like bet, and hopefully, let's hope that this bet's result will turn out to be better than what it did for Danaher and Thermo Fisher.
I mean, I remember there was a time when, Thermo and Danaher, they used to kind of target, what was it, like 10 or 15% ROICs within 5 years of an acquisition, right? Something like that.
Oh,
They used to put some firm target out there.
such quaint
You're,
times.
I know you're not getting 10 to 15% ROICs on paying, 50 times or 40 times EBITDA, right?
No,
Within 5 years. So,
I think
um,
I don't know whether it's Danaher or Thermo. I think they did some like this crazy deal, and they mentioned like something like 8 or 9% ROIC, like 5 years after the
okay.
deal. Uh, or something like mentioned, they like 200 basis points spread over their cost of capital after like 5 years. So
Yeah.
yeah, so they're kind of they were kind of convincing themselves like, yeah, it still makes sense, let's go for it, right?
Yeah.
But I think the way they were kind of communicating this deal, if you go back like 2-3 years ago, you can sense that they kind of needed to do some convincing themselves to go for these deals. But probably the primary impetus for these deals is basically that uh, my competitors are doing it, so I need to engage in it.
Yep. I think that's right.
Okay,
Yeah.
let's move on to the next topic.
Okay. Yeah. So this next topic concerns Fiserv specifically, but I wanted to
uh,
broaden this out into a larger conversation about management credibility and
sure.
the amount of spin and obfuscation we're willing to tolerate as investors when we buy certain companies. So let me just set this up first. So
Mm-hmm.
Scott Alexander, who writes Slate Star Codex, now it's called Astral Codex 10 or something, but one of
Mm-hmm.
my favorite blogs. He
Mm-hmm.
once wrote an article titled "The Media Very Rarely Lies." Okay, and
Ah.
here's what he says in it, and I quote: "The media rarely lies explicitly and directly. Reporters rarely say specific things they know to be false. When the media misinforms people, it does so by misinterpreting things, excluding context, or signal boosting some events while ignoring others, not by participating in some bright line category called misinformation." And, I was reminded of this while I was like re-underwriting these legacy merchant acquirers like Fiserv and Global Payments and so on. And,
Not something that Scott Alexander probably thought that anyone would do, right?
yeah.
Connecting media rarely lies to legacy payments. Okay.
Yes. And, so like some companies are run by, these owner managers who have a direct kind of balls and strikes way of talking about what's
Yeah.
going on with their business. So like Warren
Mm-hmm.
Buffett famously comes to mind,
Sure.
Mark Leonard, like these guys, they don't shade the truth, right? They just kind of like
All right.
tell it like it is. And then you have companies that are typically run by professional managers
Yes.
where you just constantly find yourself having to like sift through the bullshit and reading through the tea leaves. Like these guys, they speak in these like cones and riddles and euphemisms, and you need to
Yeah.
just like squint really hard to find out like what's
They're not
going on.
lying. They're not
They're
lying.
not
They're just
exactly lying.
obfuscating.
Right.
Yeah. Yeah.
Yes. And so it's obvious enough why management teams do this. Personally, I really think that they do themselves and shareholders a disservice. I think it's bad for just market confidence. If I had to advise management teams on shareholder communications, it would just give it to us straight, like stop twisting things around. I think most people can handle the truth better than they think. And people just respect you more for just telling it like it is. And anyway, this is relevant because I honestly don't know if there's a bigger recent offender in this regard than some of these legacy merchant Fiserv in particular, right? So there were two big disclosures in Pfizer's last earnings call that I think are worth mentioning in this respect. So first, let's talk about Argentina. So there's a lot of hyperinflation in that country, which served as a tailwind to Pfizer's organic growth in 2023, 2024, and to a lesser extent in 2025. So in past years, management excluded the transitory impact of the transitory inflation impact in Argentina. And when they did that, the organic growth came in at 12% in 2023, 11% in 2024, 8% in the 6 months to 2025. Okay, so still very healthy growth compared to the mid-high single digits out of Global Payments and Fiserv. And in the most recently reported results, however, they excluded all of Argentina, not just the transitory inflation in Argentina. And when they did that, the organic growth was more like 6%. So and what I find a bit suspicious here is that first, deciding what counts as transitory inflation seems like a bit of a subjective exercise. And it seems almost too convenient that whatever figure they picked for transitory inflation still allowed them to report double-digit organic growth that the market was expecting. And the second thing was Argentina's contribution was just much, much bigger than anyone expected. And they should have called this out in the past, but they didn't, because I think that they knew that doing so would have had a damaging impact on expectations. So just to be clear about this, in 2024, when you exclude what management deems the hyperinflation component of Argentina, organic growth was 11%, which is in line with expectations. When you exclude all of Argentina, not just the hyperinflation piece, organic growth is more like 6%. So even when you exclude the hyperinflation component piece, Argentina was still a massive contributor to growth. And I think it's fair to say that investors definitely would have been surprised by this, and management, should have called this out at the time. And by the way, I should say I messed this up in my Fiserv post. So in my Fiserv post, I made the incorrect assertion that management had failed to call out a past reporting error with respect to Argentina's contribution to organic growth. But what actually happened is that they excluded the transitory hyperinflation from Argentina in the past, and then they excluded all of Argentina in the most recently reported numbers. So I was comparing two different things. So I will make this correction in the write-up. And then I think like the second big thing about this Pfizer debacle was how past management chose to characterize revenue growth at Clover. So Clover is their point of sale system. It's their version of like Square and Toast, basically. And so like the bizarre thing about Clover the past few years was this growing divergence between volume growth and revenue growth. So if you look at Clover's volume growth, volume was growing about 15% year over year and then 8% year over year. But then you look at their revenue growth and it would be more like 25 to 30%. So why would volumes be growing at, 15%, 8%, and revenues growing at 25 to 30%? Well, that's a huge discrepancy. And you didn't see that discrepancy at Toast and Square. So at Toast and Square, revenue growth and volume growth, they're pretty close together. And so Pfizer's management, they'd be asked about this every now and then. And what they'd say is, remember guys, we're not just selling payments processing, we're also selling software and value-added services into the Clover merchant base. This is the consistent line, right? So now when you hear that as an investor, what you're imagining is that the company is being successful in cross-selling more products into the merchant base, right?
Absolutely, yes.
That's the total natural interpretation here.
Yep.
But instead, it turns out what was happening was that Fiserv was imposing all these ridiculous fees on merchants, right? Now, now look, there's plausible deniability here. Like, so management could just shrug and say, hey, look, we said we were cross-selling more value-added service. We didn't specify whether that took the form of units or price, right? but obviously that's disingenuous, right?
Right.
Um,
Right.
and I just want to give like one more non-Fiserv example here. So, I mean, I was looking at this company Avantor recently, and so Avantor, it's kind of like a poor man's Thermo Fisher.
Okay.
And I don't want to discuss the business in depth now. I'll have a write-up
Even
on it
the
sometime.
Thermo Fisher is not doing that great, David.
No, these guys have Avantor has imploded. It's yeah, one of the worst offenders in space. But I may have a write up on this maybe next month. My point here is
Okay.
that, like, look, everyone loves bioprocessing, right? The
Mm-hmm.
products are spec'd in, as everyone likes to
Right.
say, right? And
Yes.
so Avantor, they would always stress that like a quarter of their revenue and a much bigger percent of their profits, maybe a third of its EBITDA, came from bioprocessing, right? But what they didn't disclose until just this year, as things went to shit, was that something like 30% of their bioprocessing revenue came from what they call controlled environment consumable, CEC. So this is stuff that relates to clean rooms, like sterile gowns and gloves and masks and sterilization chemicals, air filters, that kind of stuff. Now, I don't know about you, but when I think about bioproduction, I'm thinking about stuff like single-use bags and
Right. Yeah.
bioreactors
Yeah,
and
for sure.
and chromatography columns. Okay, I'm not
Yeah.
thinking about PPE equipment. Like, nobody is, right? Because that stuff is not a direct input into bioproduction. It doesn't
Yep.
touch the drug product.
Yeah.
And management knows this, and they know
Mm.
that CECs are not as like regulatorily locked in as, you know, other bioproduction consumables are, and that investors would care about this, and they chose not to disclose this anyway. And look, like, and all of this it just gets me thinking, like, you know, how much spin should we tolerate as investors? Like, I think spin is unavoidable. I think almost every CEO does it, and I think partly maybe that's due to this like short-termism among investors and the sell side. Because I mean, it really does feel these days that there's this expectation from investors that stocks they own need to be working and going up at all times. and I almost feel like management teams, they sense this and they
Yeah.
respond by hiding uncomfortable truths and putting like a positive spin on everything. And look, like, to be clear, I'm not talking about like future projections. I mean, like, management teams, they try to predict the future. Sometimes they get it wrong and investors get mad. And that's kind of the investor's fault, not management. Like, you have to think independently about how the future will unfold. And I'm also not necessarily talking about like adjusted EBITDA metrics either, because, like, when companies disclose adjusted EBITDA,
Yeah.
they also disclose its components. So you can
Right. You can
include
choose
or
to adjust or
exclude.
not adjust. It's up to you.
Exactly.
Yeah.
It's up to you. And
Mm-hmm.
what I'm talking more about is just like straight up, like, hiding material information that investors want to know about. Like, when Pfizer's management team says Clover revenue is growing faster than volume, and that's because they're selling more value-add services, but they fail to mention it's because they're reaming customers with these massive fees.
Yeah.
That to me goes beyond positive top spin, right? And so, like, I wasn't invested in either Fiserv or Avantor, but I could have seen myself getting involved
Mm-hmm.
and getting rug pulled in this
Mm-hmm.
way.
Yeah.
And so I just think, in this space between, Warren Buffett and like Jeff Skilling, there's a lot there's a lot of gray area
Yes,
behavior,
for sure.
and it's not
There's a
illegal.
lot of space there.
Yes, and it's not
Yes.
illegal, but it might be borderline unethical, right? And it's kind of up to each of us where we decide, like, what kind of behavior we're willing to
Tolerate.
tolerate here.
Yeah.
And
Yeah.
look, I mean, like, personally, from my perspective, I expect management teams to spin. I expect them to point out the
Right.
sunny side of things. I
Yes.
expect them to be overconfident in their
Mm-hmm.
projections, because a lot of times, like, these guys, they actually believe what they're saying. Like, do
Absolutely. Yes.
Yeah, like, do
Yes.
Elon and Jensen believe their own hype? I think they probably do, right? Like,
Probably do.
um,
Yeah.
yeah, and so, like, where I probably draw the line is when when spin turns into like deliberate obfuscation. It's obfuscation. It's like when you hear a question, right? And you give and they give an answer that they know to be misleading, as in the Clover case. Like, I think what's more complicated is when you never even think to ask the question in the first place, right? Like in the Aventor case, there's no reason to think that bioproduction included a bunch of CECs, right? You wouldn't even know to ask that question. You know what I mean?
Absolutely.
So that's what makes this hard. But like presumably like these executives, they have like theory of mind, like the rest of us, right? They can put themselves in our shoes and know that we would be surprised to learn that 30% of the bioproduction revenue comes of CECs, and that people would want to know this, right? So I don't know.
I mean, I'll say though, I don't have obviously any strong disagreement or anything like that when it comes to specifics of the examples that you just mentioned. But I do suspect if we speak in generalities, like, just in general, what, like you said, what should we tolerate? How much obfuscation, should we think is justified? I think it's just going to be, it's just going to stay a very, very hard question to answer. Frankly speaking, when I think about it, at least the companies that I studied in the past, and let's say just based on my own experience so far, it does feel like unless you are the owner operator, unless you are the founder, it is a very difficult thread to needle.
Because they're worried about their own jobs in a way that owner
Exactly.
operator may not be.
It's just so hard. Like, these jobs are so well paying, and they are at the peak, right? So there may not be any job after this, right? For many of them, and if they don't have the plausible deniability, right? For example, it's not us, it's the industry. Like, what could I possibly do, right? And then just gradually, let's say, leave the role or resign after 3-4 years of failed, attempts of reviving the business. They can still have a future, but I feel like if they become like, I'll give you an example. I was just writing about this today. I think Michael Burry recently published something that Cisco said back in 2000, right? Like, as the market was kind of crashing every month in the year 2000, if you listen to Cisco's earnings calls, things seemed fine, right?
Yeah.
The internet revolution is still ongoing. Usage is accelerating. They feel super lucky and grateful to be at the center of the internet revolution. All this good stuff, right? And frankly speaking, just reading that made me appreciate that if you are waiting to hear from big tech management telling us, used to say demand is outstripping supply. Oh, too bad. Things are kind of changing. Now the supply is outstripping demand. They may eventually say that, but it's probably going to be abundantly clear to all of us that that's what's happened. Now, literally, there's no anticipation to it. The moment Sundar Pichai or Andy Jassy are going to say, "Oh, the supply is outstripping demand," there is not a single person in the investor community who will be shocked to hear that. That's my guess, right? And I was then just thinking, okay, what happened in 2021, 2022 period, right? So, for example, there was a noticeable slowdown, right? So 2021, if you look at this big tech sort of income statements, it was like a hockey stick for all of them, right? And then there's this steep deceleration in 2022. And you wouldn't really get that sort of, they didn't give you like a signal, or they didn't give you as you point out, there was plausible deniability. There was uncertainty. Like, for example, Amazon was investing hand over fist on retail footprints. There were plausible scenarios that maybe the people who got habituated with e-commerce or the online groceries, maybe they're not going to go back. Right? Maybe it's it may not be accelerating from obviously COVID trend, but the deceleration will probably be much more subdued than what actually happened. Right? Not an unreasonable expectation, I would say, even though that's not what happened. Thought about it. Okay, the only company who kind of gave, I would say, some warning was Meta. Right? They actually quantified $10 billion headwind for ATT. Right. Obviously, you could argue they might have other motivations. Like obviously, they were trying to make the case to the public, to everyone who's willing to listen. Like, hey, Apple is coming after us. Apple is coming after all these SMBs. Like, we may be fine, but if the SMBs, many of them will die. Right. And they were trying to kind of, make the case like it's a $10 billion headwinds. It's not like two, three shops. It's probably going to thousands of millions of, on a mom and pops who will lose their livelihood because of this Apple privacy narrative. Right. And part of me, I remember how investors reacted over the course of that year. Right. If you listen to each of 2020 calls of Meta, in retrospect, Zuckerberg was, I would say, quite frank in assessing what's about to come, right? And he tried to communicate to the extent he can beforehand, I would say. So I think that one of the primary reasons he could do that, like he is the founder, right? And he has controlling voting share. I do think if Zuckerberg didn't, even if he is the founder, if he did not have controlling voting share, there is a very strong possibility that he would be fired. After like that 3Q 2020 call, there would be a very strong possibility that he would be fired. If someone's stature of Zuckerberg might have faced that possibility, imagine the potential risk and challenges a manager who does not have that claim to sort of fame as Zuckerberg has on the success of the company. So I think it's like you said, it's going to be very difficult on an ex ante basis to properly evaluate to what extent it's spin, to what extent it's just delusion, to an extent, right?
Yeah.
To what extent it's just not lying directly, but also, as you said, they are supposed to have a theory of mind, so they know what exactly we are thinking, and just carefully choosing the words very carefully, not to say the wrong thing, right? So it's just going to be very hard to do, but it is going to be especially hard if you are just a manager, not an owner, operator, or founder. That's why I was actually thinking, like, maybe Mark Zuckerberg is probably the key, the commentary Meta or Zuckerberg will provide in the next, let's say, few quarters may have more signal to, let's say, where we are in the AI cycle than, let's say, what Andy Jassy or Sundar Pichai or even Satya Nadella are going to say in their respective earnings calls.
Yeah. What makes this hard is I think there can be reasonable areas of disagreement as to like what might be shady and what's valid. And so like you mentioned, like Michael Burry earlier, I mean, like a very topical example of this is like thinking about the depreciation debate, which you've written about quite a bit. And so like when hyperscalers...
People will be very, very angry, David. If they do impairments, they'll be very angry. They'll be like, Barry mentioned these guys are cooking the books.
Yeah, exactly. And so when a hyperscaler extends the useful life of their chips for GAAP purposes, one way you can interpret that, is like, management teams being shady. And that's sort of the implication that I think Mike Burry is suggesting. Now, personally, I don't see it that way. I think it's a genuinely, but I think it's a genuinely tricky question, this matter of economic useful lives. And I think like this debate over like, hey, does the GPU generate profits over 2 years or even 8 years? It's a bit misleading because, I think you want to be thinking about things in terms of like their weighted average useful economic life. Like just because a GPU generates profits over 8 years doesn't mean its economic useful life is 8 years.
Right.
I mean, like, I think in theory, like if you can say, okay, the chip generates profits, $100 of profits over 8 years of its life, but 30% of those profits are in year 1, 20% year 2, et cetera. You could actually get to a conclusion where like the weighted average life is like 3 years, right? You could.
Possible.
And so, it's possible. But nobody knows like what.
Nobody knows.
nobody knows if like truly
the people who have the best visibility are the big tech like C-suite, but even they don't know. Even they don't know.
Right. No, exactly. Yeah. How could you, right? This is all kind of new, fresh unexplored territory. You can't possibly know with a high degree of certainty what the economic profits of these chips
Yeah,
will be over that
exactly.
period of time. Like you just can't.
But this is
Um,
exactly what kind of, gives some sort of like, ammunition to people with, let's say, or the bad actors. Like, as you were saying, that it's actually very hard. Like, obviously, if, for example, these big tech companies ends up recognizing impairments for these depreciations, or like, sorry, the impairments for the GPU, or the investments that they made over the last like few years, people will be very angry, because this has been kind of a talk of the talking point from many short sellers, especially led by Michael Burry. People would be guessing, or speculating, or assigning very negative intention from big tech management
yes.
perspective, right? And we are saying, not knowing how this will turn out, but we are saying today, sitting here in 2025, that hey, it's actually possible that what big tech management is saying is probably in the realm of reasonableness, right?
Yeah.
And but also, maybe someone else. Like, I think actually there is a very wide divergence, even how each of these companies actually estimate their useful life. I think Amazon is right now the lowest, and then there is CoreWeaves, who probably like say like 8 years or something like that. I may be wrong. Don't quote me. I'm not following Corey, religiously, but I know they are probably on the higher side of it. So it's possible that one of them is very aggressive, right? And
Yeah.
one of them is maybe conservative, maybe reasonable. Like, those are kind of like, and to what extent? Let's say, I'm not saying it is the case, but let's say if Corey is 8 years and it turns out to be
Mhm.
4 years, is Corey management intentionally massaging the book, or or like they are kind of delusional, or they're kind of making a reasonable case today, but they just don't know they are wrong? Like,
Yeah.
how do you really assess that?
The only way to like really get a firm answer to these questions is to have like access to private conversations that probably go on behind the scenes, and because you can't, it's hard to know the intent, right? I mean,
Yes.
what we're really getting at is like, what is the intent?
What is the intent? Exactly.
Yeah, and it's
Exactly. I
hard
think
to
that's
know.
the key. That's the key. Again, this is why I feel like I feel more comfortable when these kind of intent-based decisions are coming from someone who owns the company, who
Yes.
right,
Yeah.
founders of the company.
Yeah.
They are not trying to massage the book to make it look good for the next couple of years, right?
Yeah.
They're trying to run their business for for a long time.
I mean, I agree.
Okay, let's move on to something else. Do you want to talk about Wise and stablecoins, or DoorDash problem? Pick
Yeah.
your choice.
Yeah. We could do Wise. Yeah. So, yeah, I guess I don't know how much of this will be new to people who are listening, but I'll just kind of throw it out there anyway. I think, I feel like, there's this bear case for Wise with respect to stablecoins, which is that, Wise differentiates by making cross-border transfers very fast, nearly instantaneous in most
Mm-hmm.
cases, and much cheaper than sort of a traditional bank-led transfers. And stablecoins, they do exactly the same thing. They provide instantaneous settlement, only on a blockchain, right? But of course, like the key thing to understand here is that Wise is not just in the business of transferring value; it's in the business of transferring value and converting currencies, right?
Mm,
And
mm,
stable coins don't address that second piece. So if you want to send parents, your parents in Bangladesh some money,
mm-hmm.
you would need to convert the dollars in your bank account here to was it takas? Is
Yeah,
that what it?
Taka.
Okay,
Yeah.
takas in the bank account over there. And stable coins handle like that middle mile, but then there's that last mile problem that stable coins don't address, the on ramp and the off ramps of
Yes.
different
Yes.
currencies, right?
Mm-hmm.
And and the way Wise addresses this is through this clever setup where they convert a cross-border transfer into a pair of two domestic ones. So if a German person were to send money to a British person with Wise, how that happens is the German pays euros into the Wise German bank account, and then
Mm-hmm.
Wise pays British pounds to the Brit out of its UK bank account, right?
Right.
So money isn't actually crossing borders at that time, right?
Right.
And so this is not me being a bear on stablecoins, I think there's several valid use cases for stablecoins. They can be like a store of value for people living in unstable
Sure.
economies.
Yep.
They're also very useful in like large cross-border B2B transactions where things are already settled in US dollars, and trade partners, they keep dollars in perpetual circulation anyways, right?
Mm-hmm.
And so but the I think like the existential risk for someone like Wise with respect to stablecoins would be if stablecoins became a medium of exchange in non-US countries, right? So if the merchants in Bangladesh started accepting US stablecoins, right? Then you could just send your parents stablecoins and not have to worry about the conversion issue at all, right? But
Why would Bangladeshi government would be okay with that?
yeah, right. I don't think they would be. I think many countries would resist losing their monetary
Right?
sovereignty. So it's not
Yeah.
something I see on the horizon. Now, like there is there is this related issue of the blockchain though. So setting the stablecoin piece aside. So there's this recent announcement that 30 banks who are currently using the Swift protocols launched the digital ledger.
Uh,
And so this is interesting because you know, rather than interacting through these protocols and having money like hop from your bank to a correspondent bank to another correspondent bank to the recipient's bank, the banks who adopt this digital ledger would be able to settle transactions on this shared blockchain, right? Now, is this better or faster than Wise? I don't think so, because again, Wise is not moving money across borders as it is.
right,
It's just
right.
making these
Yeah.
two domestic transactions. Um,
Is it instant? Like, since the money is not crossing the border, is it instantaneous when you're using Wise or not quite?
Yeah, it's a good question. In some cases, it is. Well, in the majority of cases, so in some countries, Wise has a direct connection into the local payment rails, and in those circumstances, the payments it's pretty much instantaneous,
I
right?
see. Because when I
Uh,
imagine stablecoins, I feel like that's the first, like, use case that I
yes,
think about is instantaneous. Right? I don't
yeah,
have to wait for 2 days or 1 day or whatever, right? So to me, that's the primary use case, not that like, people in Bangladesh are just going to use stablecoins, because I feel like all these governments will just wake up and say, hey, it's not okay. It's we don't want to lose our monetary sovereignty to like in US based private companies, right?
yeah, yeah,
Uh, so so that's why I feel like that's use case to me feels obviously a lot of people talk about it, but I just feel it's a bit more far fetched. But the instantaneous
yeah,
piece feels appealing to me.
yeah, exactly. And so, like, I think a key risk here with this new digital ledger that these 30 banks have is that it's in theory like a huge improvement over the existing Swift network, okay?
Okay.
And so by
Okay.
extension, that does narrow the speed advantage that Wise has in that middle mile.
Hmm.
Um, and that's important because like Wise is the challenger here. So as the challenger, you need to be much better than
True.
the incumbent product that everyone's used to, right?
Right.
And so, but there are again like two wrinkles here, right? Which is first the speed advantage to this new digital ledger assumes huge adoption across all these Swift banks. Because in order for this to work, for it to have these instantaneous transfer, everyone needs to like buy into this in a sense, right? And
Hmm.
I think that's far from given.
Right.
Um, and then the second wrinkle is that Wise has this like very sophisticated like treasury management function where it tries to predict demand for different currencies across these different corridors.
Hmm.
So it needs to have like the right amount of currency in this country and that country, right, in order to
Yeah.
minimize the FX spreads.
Yeah. You need to
Um,
have some predictability in terms of how much you want to keep as you are kind of paying back and forth, right? If you
yeah,
don't, especially if
exactly.
you don't want money to cross the border, so you need to have very good predictability or model how much money to keep in each of these countries,
Yeah,
right?
exactly.
Yeah,
And so Wise, it can kind of choose when and how much FX to trade during favorable times, right? And so
I
they don't
see.
have to. So Wise doesn't have to be a forced buyer of currency, I guess is what
Got
I'm
it.
saying. And
Mm.
and um and it can do this because Wise is like one entity that's managing all these different pools, right? But that
Mm.
wouldn't work nearly as well if you had like a thousands of independent banks, each
Right.
and each of those banks had their own like idiosyncratic
Yeah,
needs,
that
right?
feels
You
more
couldn't coordinate
inefficient,
that.
right?
Yeah,
Yeah.
yeah. I
Mm.
think like if I had to think really of a reasonable scenario that would put Wise at risk here, it might be something like central bank digital currencies become a real thing, and then those central banks allow their currencies to be shared on a common ledger, and they also provide like a centralized order book to exchange one CBDC for another. So a project like there's this project called mbridge, right? It's the shared ledger developed by the Bank of International Settlements in partnership
Mm-hmm.
with various other central banks. And I can't remember all the banks who are involved. I think it's like China, Hong Kong, Thailand. Um,
Okay.
but essentially, they allow commercial banks to hold CBDCs on the shared ledger and trade them. And so then you might imagine like a centralized real-time FX exchange order book accompanying that ledger too. And so that would make the settlement faster, and it would make the FX exchanges faster and cheaper as well. And so there's that kind of scenario where the central banks kind of coordinate together, and they create like this very liquid centralized order book for the FX exchange. But even here, I think this is a bit far out there, because like there have been other attempts to link real-time payment networks across countries,
Right. Yeah.
different countries at different times, and it just hasn't really panned out. I'm not sure why this time would be any different. It just feels like very hard for countries to like coordinate when it comes to like payments. It just seems to be
Yeah, it's kind of pretty
kind of a
sensitive,
perpetual
right?
question.
Like,
Yeah,
and I think it, obviously this is quite sensitive data information, and also uh, there's also a big sense of inertia, how things
yeah,
are done. Like, frankly speaking, the idea of money is quite complicated, right? You
yeah,
know, we just if you go and ask around people, like 10 people or 100 people, like, hey, what do you think? Is the idea of money simple or complicated? Probably 99 of them will say, oh, it's pretty simple, right?
yeah,
But actually, how the money is created, how it's circulating, M1, M2, M3, like this can be super complicated, even the current system, right?
yeah, yeah,
And I think almost nobody quite, appreciates the complexity of the status quo. Is just, the inertia. Like, oh, it's just the way it is. We kind of grow up with it. Like, we kind of know. We feel like we know how it works, although we don't quite know. But we kind of feel like how it works. But when you say, hey, whatever system that we have, now we want to change it. Now I'm like,
yeah,
okay, what is it going to be? And then people start talking like, okay, I don't understand what you're talking about.
yeah,
Well, most people actually don't even understand the current system, but that's okay because it's
yeah,
current system, right? We already
yeah,
kind of, got on with it. But if, for example, if you all use Bitcoin and then we wanted to move from Bitcoin to, let's say, or even the CBDCs to, let's say, status quo, I don't think you could do that. Right?
yeah,
Because, the current system is actually way too complicated. And if you say, oh, this is what we're moving to, like, why would you do that? Like, why would you have all these sort of, complicated rules and systems and policies? Let's just stay where we are, right?
yeah,
So I think that's when I think about, stable coins, crypto, whatever, I feel like inertia is underestimated. Uh, and I don't know all the reasons why these earlier approaches didn't quite work or pan out. Uh,
yeah. I
but
feel
yeah,
like there's
obviously,
just a lot of path dependency to this stuff
exactly,
of how
exactly.
things end
That's
up,
the right word.
and
That's the
it's
right word.
yeah.
It's
I
very
mean,
hard to
you can,
design it. It's very hard to
yeah,
design from the get-go. It's just, there are a lot of path dependencies. Can things change? Yes, they can be, but I think it's very hard to forecast how the end sort of result looks like. And a lot of people are obviously, bullish about stable coins, and I feel like I don't follow Wise or Remitly very closely, but they come to my Twitter feed pretty frequently. Is stablecoin the sort of primary bear case for these companies, or not quite,
yeah. It's
or
a
it's just
big,
something different?
it's a big overhang for both
Big
companies. I
overhang, I
think,
see. Yeah, yeah,
yeah,
yeah.
and
Okay, interesting.
and it's yeah, and I feel like even if you have the technology figured out, like there's just a big coordination problem when it comes to
Yeah,
payments that you need to somehow um surmount, and yeah, I don't know. Like I hear a lot of people talking about how like Walmart and some of these other big retailers could just start accepting stable coins, and then they could cut out the interchange fees, right? And I feel like the big problem with this is like you have to incentivize consumers to use the stable coins instead of like their credit cards, right? Because
Right.
consumers are earning rewards when they swipe with their credit cards,
Yeah,
right?
for sure.
And
For
so like
sure.
if you're Walmart and you want your shoppers to use like your own proprietary, wallet or coin or whatever, you have to get consumers on board with that, which means like you have to give them some kind of discount on the products that would be even
Yeah.
deeper than the interchange you're already kind of paying, right? I don't know. I've always been sort of perplexed by why people see that as such a huge bear case, but I don't know.
Maybe,
Maybe I'm missing something.
maybe in 20 years, there will be only Amazon and Walmart, two companies, right? So then customers will not have enough power. These retailers will have all the power, and they will dictate what you need to use, right? Not the other way around.
Yes.
Yeah. So like I for example, I think I went to Walmart a couple of weeks ago, and I didn't have my wallet with me. And I thought that was fine. I was not supposed to go to Walmart. My wife just texted me that I need to bring something, and I thought, okay, the Walmart is nearby, so I would go there. But then I realized I don't have wallet with me. I just have my phone with me, and they don't accept Apple Pay. So I had to go to the nearest Safeway to get the thing. So yeah, even today, Walmart is pretty adamant in dictating what you can or cannot use. But yeah, I agree. Uh, in general, customers have a lot of power. If you are not being able to convince the customers why they should use a particular stable coin, the status quo with all these points and all these discounts and offers, promotions, I feel like most customers think the status quo is working just fine.
Yep. Okay.
Okay, sounds good.
Stuff. All right.
We can actually probably mention that we will not have any podcast in the month of December. There will be a hiatus for a month or so, and we'll come back in January with more vigor and more interesting ideas in a new year. Hopefully, I think by the time last January, so I think Big Tech will probably start reporting their Q4 earnings. So maybe
Yep.
we'll have some more thoughts on
Yeah, I'm sure we'll
how
have a
this
lot to say about
depreciation
that.
schedule and all that and AI stuff is evolving. We'll probably have some more thoughts to it.
Yeah.
Okay.
Good stuff. All right.